Hello, Shahra Tadayon. In this video, I like to talk about the nature of organizations in the US for their tax treatments. I am licensed by the Treasury Department in the area of taxation, admitted to practice before the IRS, title of enrolled agent, holder of doctorate degree in finance, master's in business and economics. I'm practicing over 30 years in state of California. For tax purposes, organizations are categorized by individuals, business, trust, state, fiduciary, and gift taxes. Today, I like to talk about business types of entities and their tax treatments in US. And most popular business entities in US are sole proprietorship, general partnership, limited partnership or LP, limited liability company, S corporation, C corporation, limited liability partnership or LLP. Sole proprietorship is the most simplest business entity, is basically by individual and without any registration to the state of any state that they are in, and a very simple form of entity and no protection or no limited liability protection. General partnership are the same, similar to the individual or sole proprietorship, and the key difference is that general partnership, they have to be two or more, and very simple to form, and no liability or protection because they are not registered by the states. The next level is limited partnership. Unlike general partnership, a limited partnership or LP is a registered business entity, and LP, they have to be two kinds of partners: those who own, operate, and assume liability for the business, they call them general partners, and those who act only as investors or limited partners, sometimes they call silent partners. The next step is limited liability company. Limited liability company, the same as LP, limited partnership, has to be registered in a state and follow the rules of each state. LLP could be formed in the formation could be as individual or C corporation levels for their tax treatments. For federal level, limited liability company has to be two or more, otherwise it will consider disregarded entities. In some states, such as California, they call it SMLLC, single member LLC, which is disregarded entity, and they don't have federal taxation. So SMLLC is treated on their individual level, either a Schedule C or a Schedule E, depending on the nature of business. And the limited liability company is a pass-through entity. It passes through K1 to the individuals and has protection, mostly formed for the protection of property, especially in California, and has a good protection. The next step is S corporation. S corporation has some limitations in the number of shareholders, maximum 100, And the shareholders, they have to be either American citizen or green card holders. Another limitation on this entity is that this entity cannot have shareholders other than individuals or certain type of trust. And this corporation, S corporation, they have to have, after the formation, they have to have some special form 2553 in order to elect to become S corporation if they are qualified. They call it subchapter S2553. The good thing about S corporation is that it has passed through from federal K1 to individual level, and the state has very small amount of taxation on the net. For example, California is 1.5% of the net. Now we're talking about C corporation. C corporation, there is no limitations in the number of the shareholders or the members or shareholders. They could have individuals, they could have any entities, LLC, LLP, and so forth. And also there is no limitation on the status of the individual. They don't have to be green card holders or American citizen for sure, but they have to have tax ID number in US. One of the major problem with C corporation is double taxation. This entity has high federal tax and also state, and the net of the income goes to retained earning, then they have to pay on the individual level. If it passes to individual, they have to pay taxes on the dividend that they receive from the C corporation. So it is not fit for everybody, but it has some benefits. We have another entity, we call it limited liability partnership, or LLP. Is a partnership in which some or all partners, depending on the judiciary or jurisdiction, have limited liabilities, if therefore can exhibit element of partnership and corporation. In an LLP, each partner is not responsible or liable for another partner's misconduct or negligence. So LLP is mostly for professionals, attorneys, doctors, or accountants, or some other professionals that they want to have the same time economics of skills to have a larger partnership with each other, and also have at the same time to have some kind of limited liability for negligence of another. Overall, the most important in choosing the right entity is important for individuals, because at the end you have to see what is the protection level. Are you looking for protection? Are you looking for tax savings? So choosing a right entity is the most important, I will say, elements in this regard, especially for their tax treatments. There are so many other details that I will talk next time on the next video. Thank you for watching, and thank you for listening and watching.